Hello everybody, this is the Average Investor here again. This is my next video regarding the Intelligent Investor, Pearls of Wisdom. This is the continuation, the 8.3, and in this video I will speak about the buy low, sell high approach. This is Benjamin Graham spoke about this in the eighth chapter, and what he stated was basically that the general investor cannot make money by forecasting market or price movements. And the theory is that the idea behind the buy low, sell high theory is one buys after each major decline and then sells out after each major advance. And Benjamin Graham said that this may have been the case in the years before 1950, but that was no longer the case when he was writing this in the 1970s. So a quick example could be like Apple. At one point, Apple, before its stock split, was rising really, really high at one point 700, then dropped back down, and then went back up. And the idea is trying to time when I should buy or sell stock. And according to Benjamin Graham, this is not a viable option. So he said that between 1897 and 1949, there were 10 market cycles of low to high and then back to low. And all of the bull markets had a number of characteristics in common. And he stated five of them. The first one is a historically high price level, a high PE ratio, a low dividend yield against bond yields, speculation on the margin will be high, and new stocks of poor quality will be coming out. Usually, these were the characteristics of a very high bull market. Therefore, it was surmised that intelligent investors could identify periods of buying and selling that would develop, and to develop methods to determine when is the best buying and selling levels. Um, he said that even before 1949, there were instances though when buying low and selling high would be complicated. An example of this was the bull market of the 1920s, when the market just kept going up and there was no good selling signals that one could decipher. So one could imagine, oh, the price of stock is increasing exponentially, I should sell now. And what would happen is they would be burned because they would just keep on going higher and higher and higher. And just say if a stock went from 1 to 10, they might have said, oh, that's perfect, now it's time to sell. But what would happen, it would go from 10 to 100, and this is what was happening in the 20s. And if you said, oh, I'll stop at 10 and sell, you would miss the boat and just keep on going and going, and you would lose on on those gains. So he also said during the 1950s and 70s, though, that this pattern of buying low and selling high could not then reliably used on bull market characteristics, and bull market characteristics were not accurate signals. He said that it seemed unrealistic for an investor to base his financial policy on this classical formula, especially when everyone else was using this formula. So that was basically buying low and selling high, and Benjamin Graham was essentially against this idea, although most people to this day still use this. The future video that I will speak about, according to the eighth chapter of in The Intelligent Investor, will be about formula plans. Thank you very much.